In this video, I'm going to teach you how to read stocks like a pro. You'll be able to make money by predicting the market and knowing when to buy and sell. Hey there! My name is Mr. FOMO, and in this video, I'm going to teach you how to read stocks like a pro. It's actually a lot easier than you think, and once you know what you're doing, you can start making money by predicting the market and knowing when to buy and sell. So stick around and let me show you how it's done. Stocks are basically ownership shares in a company. When you buy a stock, you become a partial owner of the company that issues the stock. For example, let's say you buy one share of Apple stock for $100. This means that you own 1/1000th of Apple. If the value of Apple goes up to $110 per share, then your one share is now worth $110. You've made a 10% profit on your investment. Now, let's say that instead of buying one share of Apple for $100, you bought 100 shares of a company called XYZ for $1 each. If XYZ goes bankrupt, then your whole investment is gone. But if XYZ goes public and its stock price goes up to $10 per share, then you've just made a 1000% profit on your investment. This is why it's important to diversify your investments. Don't put all your eggs in one basket. So, what are stocks? They're partial ownership shares in a company that can go up or down in value, but have the potential to provide significant profits if the company does well. Thanks for watching. If you're new to the stock market, you may be feeling a little overwhelmed. With all of the different numbers and lines on a stock chart, it can be tough to know where to start. However, reading stock charts is actually not as difficult as it may seem at first. By understanding the basics of chart analysis, you can quickly gain insights into how a particular stock is performing. There are two main types of stock charts: line charts and candlestick charts. Line charts simply plot the closing price of a stock over time. Candlestick charts, on the other hand, provide more detailed information. In addition to the closing price, candlestick charts also show the opening price, the high and low prices for the day, and the trading volume. Once you understand the basics of chart analysis, you can start to look for trends and patterns. For example, if a stock's price is consistently rising over time, that's generally a good sign. Likewise, if a stock suddenly plummets in value, that could be an indication that something is wrong with the company. By keeping an eye on these trends, you can make more informed decisions about which stocks to buy and sell. When it comes to stocks, there are a lot of moving parts. In order to make money in the stock market, you need to have a firm understanding of how stocks are bought and sold. Essentially, when you buy a stock, you're buying a piece of a company that will be worth more in the future. When you sell a stock, you're selling that piece of the company for less than what it's currently worth. In order to make money in the stock market, you need to buy low and sell high. A lot of people get caught up in trying to time the market, but ultimately, it's more important to focus on finding quality companies that are undervalued. If you can do that, you'll be in a good position to make money in the stock market. The stock market is constantly fluctuating. Prices go up and down based on a variety of factors, including news events, economic conditions, and even the weather. While it might seem like the stock market is unpredictable, there are actually some underlying reasons why stocks change in value. One reason why stocks go up or down is because of something called supply and demand. If more people are interested in buying a particular stock, the price will go up. Conversely, if there are more sellers than buyers, the price will go down. Another reason why stocks fluctuate is because of earnings reports. Every quarter, public companies release their financial results. If a company does better than expected, their stock price will usually go up. On the other hand, if a company misses its earnings targets, the stock price will usually drop. Finally, changes in the overall economy can also impact stock prices. For example, if there's good news about job growth or inflation, that can cause stocks to go up. However, if there's bad news about the economy, that can lead to a stock market sell-off. What is the difference between a bull market and a bear market? A bull market is when stocks are generally going up in value, while a bear market is when stocks are generally going down in value. These terms come from the way that bulls and bears attack their prey. A bull will charge its prey head-on, while a bear will swipe at it from the side. In the stock market, bulls are optimistic about the future and believe that prices will continue to go up. Bears, on the other hand, are pessimistic and believe that prices will fall. Bull markets usually occur during periods of economic growth, while bear markets tend to happen during recessions. However, it's important to remember that the stock market can go through bull and bear phases even if the overall economy is doing well or poorly. How do I know when to buy or sell a stock? This is a difficult question to answer, and there's no one-size-fits-all answer. Ultimately, you need to make your own decisions about when to buy and sell based on your own risk tolerance and investment goals. One way to approach this decision is to use what's called a stop-loss order. This is an order to sell a stock if it falls below a certain price. For example, let's say you buy a stock for $100 per share. You might place a stop-loss order at $90, which means that the stock will be sold automatically if it falls to $90 or lower. Stop-loss orders can help you limit your losses, but they can also prevent you from making money if a stock price falls and then rebounds. So, it's important to use stop-loss orders carefully. Another approach is to set target prices for when you want to sell a stock. For example, you might buy a stock at $100 per share with the goal of selling it when it reaches $120. If the stock never reaches your target price, you'll miss out on potential profits. But if you sell too early, you might also miss out on additional gains. Before you start buying stocks, there are a few things you should consider. First, you need to decide what your investment goals are. Are you looking to make a quick profit, or are you trying to build long-term wealth? Second, you need to think about how much risk you're comfortable taking. Investing in the stock market comes with some risk, and you could lose money. If you're not comfortable with that risk, you might want to consider other options. Third, you need to have a plan for how you're going to buy and sell stocks. Are you going to trade frequently or hold on to stocks for the long term? Finally, you need to make sure you have enough money to cover your costs. Buying and selling stocks can incur fees and commissions, so you need to make sure you have enough money to cover those costs. Now that you know the basics of stocks, you can begin to invest in them with confidence. Of course, there is still much more to learn, but this was meant to be a beginner's guide. If you enjoyed this video and are looking for more stock market content, subscribe to my YouTube channel where I upload weekly videos on different investing topics. Thanks for watching.